in order to make sense of the level of volatility that we have documented about our exchange rates, we need to come up with a model that tells us which factors play a role in determining the level of the exchange rate E. We are about to analyze a model that takes into account the role of expectations of traders in the market and interest rate differentials. Our starting point will be the covered interest rate parity formula for forward rates. We will see that if traders in the economy have expectations that the future spot exchange rate is different than the forward exchange rate, then they will find rational and convenient to adopt investment strategies to make profits. For example, if they expect that the forward rate will be higher than the future spot rate, then it would make sense for them to sell the forward, expecting to buy in the spot market in the future when the contracts becomes due. And if they expect that the future spot exchange rate will be higher than the forward, then it makes sense to buy the forward and then sell in the spot market when the contract will be due and keep the positive differential between the future spot exchange rate and the forward rate at which we are entitled if we buy a forward contract. So if in the market all traders share the same expectations and choose in the same way, then there will be a tendency by the forward rate to be the same as the expectation of the future spot exchange rate. Such situation is called uncovered interest rate parity, and we're going to use it a lot in the slides that go from slide 20 to the following, and we will see that when the uncovered interest rate parity holds, we can make interesting connections between what the spot exchange rate should be, the expectations on the future spot exchange rate, and the interest rate differential between countries.